We're a software company, and our software platform is used by clients, large multinational clients in high consequence industries or highly regulated industries to manage their people better. And really we deal with the people part of compliance. So our platform, or our software platform, will ensure that clients' employees are fit and proper to do their job, that they're up to date with the latest industry standards, they're compliant with internal health and safety procedures or manufacturing procedures, and that they have their license to operate. And in many respects, it's mission critical. So the types of industries we focus on are transportation, which would include airlines and shipping logistics companies, financial services, healthcare, life sciences, manufacturing, and energy, which would include oil and gas extraction. So we termed this phrase high consequence industries, and it really means where there's dollars or lives at stake, and that's our focus. I joined in January 2013, and one of my first tasks was to devise a multi-year business plan. We operate in the talent management systems market, which is a $6 billion market, but we have a very small share of that market. So we raised $6 million in May 2013, and we used the proceeds to invest in the business, to grow the business. So we invested heavily in frontline sales executives, in business development, in relationship management and marketing. And the idea was to focus on clients in highly regulated industries or high consequence industries and grow the top line. And that's really where the investment went in. And it meant that we would be loss-making for the first 2 years because of the upfront investment. But going into 2015, we now have the capacity to grow the business. And it was encouraging to see the 40% revenue growth in 2014, but also the type of revenue growth was more encouraging. You know, we grew the SaaS revenues by 35%, and also we won more clients in high consequence industries, which is in line with our strategy. Our business model used to be a perpetual license model, where we would sell a perpetual license to our clients, which would involve a higher upfront fee, but the only recurring revenue was 20% support and maintenance. We've moved away from that, and part of the business plan that I talked about earlier was to move away from the perpetual model to more of a software as a service, subscription, multi-year license, or an on-premise annual license. And indeed, we reported substantial growth in both these revenue streams going forward. So we offer either on-premise multi-year annual license or software as a service, and both of them have strong recurring revenue because we sign a client typically on a 3-year deal. And therefore we have strong recurring revenues and a higher client retention rate going forward. And our target market really is highly regulated or high consequence industries. One of the main growth drivers for us is the US healthcare industry. We made an acquisition in March 2013, a small business in Atlanta, and they specialise really in supplying a packaged compliance solution using our talent management system with bundled US compliance courseware. There's 5,000 hospitals in the US. With the Affordable Care Act coming in, the compliance and regulations are only going to become more onerous. We've got about 45 US hospitals at the moment, so there's some way to go in terms of market share, and that business grew by 40% last year, so we're very confident we can continue that growth. The software as a service subscription model also grew by 35% last year, and we expect that to continue to grow, especially in the US. There's a big take-up of the SaaS model in the US. And also in Europe, manufacturing, one of our 6 high consequence industries that we want to focus on. And it's not just any manufacturing, it's precision manufacturing, so making automobiles or aeroplanes. And we got some traction in Europe last year. We won a couple of key clients in the manufacturing sector who are based in Europe. So manufacturing is also a key growth driver for us. We recognise as a board, at some point we need to start returning a profit. Part of the business plan involved substantial upfront investment in 2013, 2014 to drive sales growth. which meant we were loss-making in those 2 years. Going forward, we want to move to sustainable profitability, and therefore we have the capacity to continue to grow, but we're probably not going to invest so aggressively going forward for the growth. So we're trying to get that balance between sustainable growth and profitability going forward. I think they can look out for us delivering on our strategy and our business plan. You know, when we set out the business plan, you know, that the key points, you know, it was top line sales growth or revenue growth, which we achieved last year, 40%. But actually, looking at the detail of the business plan, we said we wanted to move away from the perpetual model to more of a SaaS, multi-year annual licensing model with better recurring revenue, and also targeting clients in high consequence industries. So whilst the headline 40% sales growth number gets all the headlines and attention, actually delivering on the plan that we said we were going to do, i.e. growing the SaaS revenue, which we did by 35%, and winning more clients in these high consequence industries. So that was more pleasing for me, is that we're delivering on this strategy, because we believe it's more defensible, focusing on these high consequence industries, and we believe that we can get more powerful pricing model by this focus. So investors can expect us to continue executing and growing our sales in both SaaS, software as a service, and winning more new clients in these high consequence industries.